Picture this. It's the first of the month. You just got paid. You open your banking app, and for a brief, shining moment, you feel rich. The balance looks good. You tell yourself, okay, this month is going to be different. I'm going to pay all my bills, buy groceries, maybe go out for dinner once or twice, and then, whatever is left over, I'm going to invest it. I'm finally going to hit that savings goal. But then life happens. The 15th rolls around. You get a flat tire. Your friend has a birthday dinner. You see a pair of shoes that are an investment in your career. By the time you get to the 30th, that surplus you planned to save, it's gone. Or maybe it's not gone, but it's terrified. You look at the $500 you have left and think, I better keep this cash just in case. So, you save nothing. You invest nothing. And you tell yourself, next month will be the one. Look, here's the thing, this cycle isn't happening because you're bad with money. It's not because you lack discipline. It's because you are operating on a monthly mindset in a world that is designed to take your money every single day. Today, I'm going to show you why saving monthly is actually the slow lane to wealth, and how switching to a specific one-week investment strategy can mathematically and psychologically trick your brain into saving double what you are saving now without feeling like you're sacrificing your life. My name is Jason, and I spend way too much time thinking about the psychology of investing and the tiny mathematical levers that make a massive difference in your net worth. If you're someone who feels like you're making decent money but your investment account is barely moving, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't just talking about saving. We are talking about velocity. So, why do we default to doing everything monthly? It's actually pretty simple. It's because the system trained you that way. Your rent is due on the 1st. Your internet bill is monthly. Your credit card statement? Monthly. Most of you probably get paid bi-weekly or monthly. We are conditioned to think of our lives in 30-day blocks. There is a concept called Parkinson's law. Usually, we talk about this in productivity work expense to fill the time available for its completion. But here's what most people don't realize, this applies perfectly to your money. Expenses expand to equal the income available. If you leave $4,000 in your checking account on the 1st of the month, intending to save $1,000 at the end of the month, your brain sees a $4,000 resource. Subconsciously, you feel safer buying that extra latte. You feel safer upgrading the flight. You feel safer ordering the appetizer. By the time the month ends, Parkinson's law has done its job. The money expanded into your lifestyle. Now, you might be thinking, Jason, I'm disciplined. I have a budget. I automate my transfer for the 30th. Okay, fair enough. Let's say you do successfully transfer that money at the end of the month. You are still losing. Why? Because you are fighting simple math. Let's look at the numbers. Because math doesn't care about your feelings, and math loves speed. Most people think, if I invest $1,000 a month, that's $12,000 a year. If I invest $250 a week, that's also roughly $12,000 a year. It's the same thing, right? Wrong. There are two major forces at play here that the monthly investor ignores. One, the time value of money, intra-year compounding. When you wait until the end of the month to invest your surplus, you are keeping that money on the sidelines for an average of 15 to 30 days every single cycle. Let's say you get paid on the 1st. You hold that cash. You wait. Then you invest on the 30th. That is 29 days that your money was sitting in a checking account earning 0.01% interest, when it could have been in the S&P 500. If you switch to a weekly strategy, you are moving money into the market on day 1, day 7, day 14, and day 21. Over 1 year? The difference is the price of a nice dinner. Over 30 years? The difference is a used Honda Civic. But if you account for market volatility, the difference can be life-changing. $2 cost averaging, DCA, on steroids. You've heard of dollar cost averaging. Buying the market regardless of price. But here is the stats breakdown that shocked me. The market fluctuates wildly within a month. We tend to remember the closing price of a month, but we forget that on the 12th, the market might have dipped 3% because of a random news report, and by the 30th it recovered. If you only buy on the 30th, you miss the dip on the 12th. If you buy every week, you are statistically more likely to catch those intra-month lows. You are smoothing out your purchase price significantly more efficiently than the monthly investor. Okay, put the math aside for a second. Because honestly, unless you have millions of dollars, the extra interest from investing 3 weeks early isn't going to buy you a private island. The real reason I want you to switch to the 1-week strategy is purely psychological. It hurts less. Let's be real. Sending $1,000 or $2,000 out of your account in a single transaction feels painful. It's a massive drop in your balance. You see the number go down, and your brain triggers a loss aversion response. You feel poorer. Because that friction is high, you will find excuses not to do it. You'll say, "Oh, the market looks high right now, maybe I'll wait." Or, "I have that wedding coming up next month, I better skip this deposit." But, $250. $250 is a grocery trip. $250 is a night out. $250 is manageable. When you set up a weekly transfer of $250, or whatever your number is, it flies under the radar of your brain's pain center. It feels like a bill, not a savings event. This is where it gets really interesting. When you move money weekly, you are artificially lowering your checking account balance constantly. Remember Parkinson's law? Expenses expand to equal the income available. If you strip that money out every Friday, your checking account balance stays lower. When you log in on Tuesday to see if you can afford those sneakers, you see a lower number. You think, "Oof, I'm a little tight this week. I better pass." You didn't spend the money because you hid it from yourself. By the end of the month, you have saved $1,000, but you lived your life as if you only had the remainder. You tricked yourself into living below your means. This also changes how you view the market. When you invest monthly, you obsess over timing the market. You sit there on the 30th staring at the ticker symbol, sweating. Is today the day? Should I wait for tomorrow? When you invest weekly, it becomes background noise. It becomes a habit, like brushing your teeth. I call this high-frequency automation. There was a study done, and I'm paraphrasing here, that showed that investors who checked their portfolios less frequently but contributed more frequently actually had higher overall returns. Why? Because they removed the emotional variable. They didn't panic sell because they were just constantly buying. If the market crashes 10% next week, the monthly investor panics and cancels their end-of-month deposit. The weekly investor just bought the dip automatically on Tuesday without even realizing it. So, how do you actually do this? Because I know what you're thinking. "Jason, my brokerage charges me fees for trades," or "this sounds like a lot of paperwork." First off, if your brokerage charges you fees for standard ETF trades in current year, you need a new brokerage. Stop getting ripped off. Here is the step-by-step framework to set this up today. Step 1. Calculate the monthly target. Don't just guess. Look at your income. Let's say you want to save $1,200 a month. Step 2. The divide by 4.3 rule. Most people divide by 4. That's a mistake. There aren't exactly 4 weeks in a month. There are roughly 4.3 weeks in a month. If you save $300 a week x 4 weeks equals $1,200. But if you save $300 a week x 52 weeks equals $15,600/12 equals $1,300 a month. By switching to weekly, you accidentally save an extra month's worth of money every year without noticing. So, take your $1,200 target. Divide by 4. That's $300. Set that as your weekly auto transfer. Step 3. Pick the day. I prefer Mondays. Why? Because Mondays are usually when the market opens, and it sets the tone for the week. You start your week by paying yourself first. If you wait until Friday, you might be tempted to keep that cash for the weekend. Step 4. Automate the investment, not just the transfer. It is not enough to move the money to the brokerage account. It has to actually buy the stock. Most modern platforms, M1 Finance, Robinhood, Fidelity, Vanguard, allow for automatic investing. Set it to buy $300 of VU, S&P 500, or VTI, total market, every Monday. Now, I can hear the comments section typing already. But Jason, I get paid monthly. I can't invest weekly if I don't have the money yet. I get it. A lot of you aren't paid weekly. Here is the solution, the buffer. You need to keep 1 month of expenses inside your checking account as a float. When your paycheck hits on the 1st, it replenishes the float. Your weekly auto investments eat away at the float throughout the month. If you are living paycheck to paycheck and literally hit $0 the day before payday, this strategy is dangerous for you right now. Your first step isn't investing. Your first step is building that $1,000 to $2,000 buffer in your checking account so you can stop writing the overdraft etch. But Jason, doesn't this make my taxes complicated? Not really. Your brokerage will send you a consolidated 1099-B form at the end of the year. It doesn't matter if you bought 12 times or 52 times, the computer does the math. Don't let laziness about paperwork cost you thousands of dollars in future wealth. Here's the harsh truth about money management. It is 20% math and 80% behavior. I switched to weekly investing about 3 years ago. And do you know what happened? I stopped feeling rich on payday. And I stopped feeling poor at the end of the month. My financial anxiety flatlined. It became a steady hum rather than a roller coaster. I realized that by making the chunks smaller, I could actually increase the total amount. I went from saving $2,000 a month to saving $600 a week. $600 a week is $2,400 a month. I increased my savings rate by 20% just by changing the frequency. My brain didn't notice the difference, but my net worth certainly did. So, here is my challenge to you. Don't take my word for it. Try it for 90 days. Go into your banking app right now. Cancel your monthly transfer. Set up a weekly transfer for exactly 25% of what you used to save monthly. And then, see if you miss the money. I guarantee you, in 3 months, you won't even realize it's gone. But you will realize that you've bought into the market 12 times instead of 3. You've smoothed out the volatility. And you've finally broken Parkinson's law. If you found value in this video, do me a favor, destroy the like button for the YouTube algorithm. It really does help the channel grow and helps us get this message out to people who are still stuck in the payday trap. And if you want to know exactly what I'm buying with those weekly transfers, you'll want to watch this video right here, where I break down my exact portfolio allocation. Thanks for watching, and I'll see you in the next one.